So the stock market is a bit of an odd place, and stuff like stock splits ain't making it any less weird. Why do they happen? How do they occur? And do they matter at all to you and I as investors? Welcome back to another fundamental video. That's exactly the question I'll try to answer in this video. Now, as always, like the video and subscribe if you want to see more. Drop me a comment with suggestions for next video's topic. Timestamps will be in the comment video description, and let's get to it. So stock splits happen whenever a company and its board, for whatever reason, decides to split the current shares of the company into many small ones. So if a company does a 10-to-1 stock split and the current share price is $1,000, they will split that one share worth $1,000 into 10 shares worth $100. So if you held 2 shares worth $2,000 before the split, you will own 20 shares worth $100 after the split. So it doesn't change the value of your investments, just the amount of shares you have. And most big publicly traded companies will have to do one or more stock splits at some point in their history. So the most notable example would be Apple, which recently did their 5th split. So they did a 2-to-1 split in 87, 2000 and 2005. They did a 7-to-1 in 2014 or so, and now in 2020 they're doing a 4-to-1 split. And the reason why they're doing this is if they didn't, their stock price would be worth like north of $5,000, I believe, at this point, which would keep out a lot of their potential investor base, because one share of Apple would cost multiple monthly wages in the US, which just wouldn't work out in the long run. So most companies have done one at some point or another. So as I alluded to earlier, a stock split does not change the value of any investor's holding whatsoever, but it can, for example, make it easier for small retail investors to balance their portfolio. So let's say someone owns 1 share of Amazon today. That means they have $3,300 worth of Amazon share. But maybe they would rather have $2,000 invested instead of $3,300. And so if Amazon did a 10-to-1 stock split, someone will be able to sell the extra amount and be left with their desired amount, so they don't feel overexposed. So of course, a lower dollar cost per share will make it easier to accurately have the exact amount of dollars invested that you want. So this is one of the small advantages of a stock split. Another thing is that more shares means more liquidity, meaning there's more shares being traded at any given time. And liquidity is never a bad thing. And for some investors who wants to buy a lot of shares or sell a lot, liquidity can be quite important, because whenever you buy and sell shares of a company, there are sellers and buyers trying to figure out the price of the stock. And the more shares are being traded, the more accurately the underlying asset will be priced. So the spread between the sellers and buyers, so what the buyers are willing to buy for and what the sellers want to sell for, will become smaller and smaller and more tight as more shares are traded. So again, liquidity, never a bad thing either. Another small thing is that a company's stock price being too high is never a bad thing. And if a stock has been doing incredibly well, the company has probably also been doing well. And you could say that a stock split is a vote of confidence in a company's share price. Although I wouldn't read too much into this, because not even a company knows if its own stock price will go up. But of course, there's a lot of upwards momentum in stocks like Apple and Tesla, so they have to do stock splits. And there's a good chance that momentum will carry on in the future. Which leads me on to another small thing, and that is that historically, companies' shares have outperformed the market, or done really well right before and after the splits. But this again can probably be boiled down to the momentum causing the need for the split in the first place. And on the flip side, companies doing reverse splits where they gather up their shares to create bigger ones because the stock price have been falling so much have underperformed. So again, it's probably just a matter of downwards and upwards pressure. So I personally would never trade around a stock split. They don't really matter. And as a long-term investor, you shouldn't really think of them as a significant event. But a lot of retail investors and regular people can't afford some of these stocks. Amazon cost $3,300, and I'm pretty sure most people can't afford that, but they are more than happy to invest in Amazon. So when companies like Tesla or Amazon or Apple does these stock splits, there are some people that will jump into the company for the first time because the stock price is low enough for them to buy. So again, stock splits are quite insignificant, but they're never a bad thing. So that's about all you need to know about stock splits. Don't click on any 10-15 minute video on stock splits. They're just trying to milk you for advertising money. So that's it. Are you excited about the Tesla or Apple or Amazon upcoming stock splits? Amazon should do one at some point, I imagine. And are you going to invest in these companies now that you can afford the shares? Are you buying more because of the splits? Are you selling off a couple of shares because you can now sort of balance your portfolio a little bit better? Give me a topic for next video. My next video after this one is going to be a deep dive on a new holding of mine, so stay tuned for that. I'll see you in my next one.